Hello everyone, I am Daulat Wadhwa doing my post-graduation diploma from Welingkar College, January 2015 batch. Today I am going to speak on GST, that's India's biggest and much awaited tax reform. And soon it's going to be a reality. You heard it right, soon it's going to be a reality. Today we'll understand what is GST. Why do we need GST? How is it different from our current system? And what are the benefits of GST? So let's go ahead and first see what is GST. GST is one indirect tax for the whole nation that will make India a unified common market. GST is a single tax or a narrow tax band on supply of goods and services right from the manufacturer to the consumer. It's a destination-based tax or consumption-based tax with credit of input available of the tax paid at the previous stage in the subsequent stage of value addition. Now, when we say single tax, that means a single tax will be levied across the states. Unlike our current system, where there are multiple taxes and different rates. GST is a tax on supply of goods and services. Now the term supply here is a new concept and a broader concept. It has been defined in GST law. Unlike our current system, where the tax is levied on manufacture of goods and services. Here the term supply includes sale, transfer, exchange, barter, rental, lease, etc. For further information, you can always refer to model GST law. Now we'll see why do we need GST. We need GST for a lot of important reasons. We'll have a look at some of the important reasons why we need GST today. So the first important reason is to simplify and replace our existing multiple tax structure. Second, to eliminate the cascading effect of taxes, that is tax on tax, double taxation. Third, to get full input of credit paid at earlier stages. And finally, to increase the tax collection and stop leakages. Now, one by one, we'll understand what does it mean. Now, in India, there are two types of taxes, direct taxes and indirect taxes. Direct taxes are levied on individuals and organizations, and it is directly paid to the government. Indirect taxes are levied on manufacture and sale of goods and services. In India, we have got a lot of indirect taxes. Some are levied by center, some are levied by state. Center levied taxes are excise duty, service tax, custom duty, central sales tax. State levied taxes are value added tax, luxury tax, entertainment tax, etc. Now, there are a lot of businesses in India who have operations in every part of India. Now, it becomes very difficult for government as well as businesses, and it requires a lot of effort to manage, comply, administer, and monitor all indirect taxes. With the introduction of GST, all the taxes will be subsumed. All the indirect taxes will go away, and we will only have one single tax, that is GST, Goods and Services Tax. That will reduce the compliance and it will simplify the tax structure in India. Now, we'll see the second reason why we need GST. The second reason is to remove the cascading effect, that is tax on tax. I'll give you an example where I'll show you what is tax on tax and cascading effect of taxes. Couple of years ago, Government of India had introduced value added tax. With the introduction of value added tax, the cascading effect was removed to a large extent, but it was not removed completely. So we'll see an example and see how it works now. So let's say the goods are moving from manufacturer to wholesaler and from wholesaler to retailer. So the manufacturer gets raw material, converts it into finished goods. Let's say the raw material cost is 1 lakh rupees, conversion cost 50,000 rupees. So total comes to 1,50,000. Now in the current system, there is the center government levies excise duty on all the goods manufactured. So this is a manufacturing process. So we are going to levy excise duty. So let's assume that the excise duty is 10%. So here in this example, you can see the excise duty comes to 15,000 and the total cost of goods becomes 1,65,000. Now, the manufacturer sells the goods to the wholesaler. It's a transaction within the state. So the state is going to levy VAT, that is value added tax. Let's assume that it is 10%. I'm just taking unrealistic figures just to make you understand the cascading effect of taxes. So these are not real figures. We are just assuming 10%. So we can see 10% VAT on cost of goods comes to 16,500 and the selling price of the goods becomes 1,81,500. Now, so far the goods have moved from manufacturer to wholesaler. Now, we'll go ahead and see how the goods move from retailer to wholesaler to retailer. So now we can see that the wholesaler has got the goods and the wholesaler adds value to it, that is his margin. Let's say it is 10,000 and the cost of goods 1,65,000. So total comes to 1,75,000. Now again, it's a transaction within the state. The state is going to levy VAT. So let's say it is 10%. So in the current system, as I said earlier, credit of input VAT can be set off against output VAT. So in this example, we can see in the earlier stage, the wholesaler paid 16,500 VAT. So when the goods are moving from wholesaler to retailer, the wholesaler gets input credit for the tax paid in the earlier stage, that is 16,500, and the VAT was 10,000. So the total tax payable comes to 1,000 rupees only. But again, as I said, in the current system, it is not removing the cascading effect completely. There are other taxes like octroi where we do not get input credit. Now we'll see how it works in GST and we'll take the same example. Let's go back and see how the goods are moving from manufacturer to wholesaler in GST system. Now again, the raw material cost is 1 lakh, value addition 50,000 and GST is a single tax. There will be no other tax. So the goods are moving from manufacturer to wholesaler and it's a tax on supply of goods and services. So here let's assume that the GST rate is 20%. So it comes to 30,000 here. So the selling price becomes 1,80,000. So far we have just taxed GST and we can see the selling price comes to 1,80,000. Now the goods are moving from wholesaler to retailer. Now wholesaler adds value to the goods, that is his profit margin. Let's assume that it is 10,000 rupees. So total comes to 1,60,000. Again, this is a transaction within the state. So the state is going to levy GST. So it is 20%, it comes to 32,000. Now, as I said earlier, in GST, we will get uninterrupted input credit of tax against output credit. Now here, in the earlier stage, we paid tax of 30,000 rupees and here it comes to 32,000. So the value addition, so the tax is only on the value addition, that is 10,000 rupees and the rate is 20%. So here you can see that the amount comes to 2,000 exactly. And the selling price, so there is a huge difference in the selling price also. So in GST, the prices of goods will also come down. Now let's move ahead and understand. So in the example we saw with the introduction of value added tax a few years ago, the credit of VAT is available against input VAT is available against output VAT only, and the credit of input excise or service tax is available against output excise or service tax. However, the credit of VAT is not available against excise and vice versa, and the credit of tax of octroi is also not available against any other tax. Now we'll go ahead and we'll understand technology for GST. Now central government has formed a not-for-profit organization to develop IT infrastructure and services. In GST, technology support is very important. You can say technology support is the backbone of GST. I mean, to implement GST, we need a very strong IT infrastructure because everything will be automated and everything will happen online. The taxpayers will register themselves online. They will pay tax online. There will be settlement of disputes online. The IGST, that is integrated goods and services tax settlement, will also happen online. So we will understand later on in the presentation what is IGST. But here I just want to tell you that the IT infrastructure is very important in the implementation of GST. It will actually keep the taxpayer, the state, center, trade, industry connected. So that is why the technology for GST, the IT platform network, is going to be very important. Currently, the Infosys, India's second largest IT company, is developing the platform to GST. And so far, everything is into place, and let's hope that it gets implemented from 1st April 2017. And all the registrations for GST will be PAN linked. So there will be no question of leakages, and it will monitor both indirect taxes and direct taxes. Now we will see the GST tax structure. I just want to tell you, just 3 days ago, the GST Council has finalized the revenue neutral rate for different goods and services. Now first I will tell you what is GST Council. GST Council is a joint body of center and state. Union Minister will be the chairman and members includes Finance Minister from each state. GST Council is going to take all the key and important decisions related to GST, like fixing the tax rates, cess, laws, everything from resolving disputes to making recommendations. GST Council is going to take care of everything. Now the GST Council has finalized some rates. So we will have a look at the rates. And these are revenue neutral rate. Now I'll try to make you understand what is revenue neutral rate. Government of India wants to protect the revenue. Government of India wants the revenue to remain neutral or unchanged. Now what does that mean? Let's take an example. Let's say that today in the current system, every year government is getting 100 crores. That is the revenue, tax revenue government is getting from in a year. Now, with the introduction of GST, government wants a rate that will give same revenue to the government. Means the government will receive the same amount of revenue. The government does not want to sacrifice the revenue. So that is revenue neutral rate. So there are 5 rates: 0, 5, 12, 18 and 28. Now the 0 rate, they do not say exempt, they say 0 rate. Now 0 rate will be applicable to all the essential goods. Essential goods includes food grains and food products. Next is 5% rate. 5% rate will be levied on the mass consumption products like soap, Colgate, etc. And the third and fourth rates are standard rates on standard products, that is 12 and 18%. And we also have a higher rate of 28% for luxury goods and demerit goods that would also attract and cess. The GST Council has not disclosed the items that will come under, the specific items that will come under each rate. So very soon they will disclose that also. We'll wait for that. Now before we understand how GST works and what is the dual GST model, we'll just have a look at the benefits to consumers, government and businesses. So as I said earlier, the GST is going to simplify the tax structure because there will be one single tax for the whole nation and there will be uniformity in tax rates. That is one. And it will also improve the competitiveness, international competitiveness of the manufacturers and exporters. Higher revenue efficiency, GST will reduce tax evasion, more money to backward stays as it is a consumption based tax and the tax revenue goes to the state where it is consumed and not to the state from where it has originated. And for customers, it's going to be a relief in overall tax burden and they will also have a clear picture. They will also know what tax they are paying. So it's nothing but single and transparent tax structure. Now let's go ahead and see how GST works. Now in India has a federal form of government. That means the governmental powers are divided or distributed between center and state. So state requires revenue to run the state and center requires revenue to run the country. So both are going to share the revenue. So let's see how it works. And that is the reason why we are going to adapt a dual GST model. Now in the dual GST model, there are 3 components. So let's have a look at the 3 components of GST. The first one is SGST. Now SGST stands for State Goods and Services Tax. It will be collected by the state on all the transactions within the state. The next is CGST, that is Central Goods and Services Tax. That will be collected by the center on all the transactions within the state. And the third is IGST. That is Integrated GST. Integrated GST will be collected by the center. But what is this integrated GST? Integrated GST will be levied when a transaction happens between 2 states. When goods are moving from one state to another state. Now we will go ahead and take an example and try to understand the dual GST model. Now before we see the example, let me just tell you one thing. The GST model or how it works, this has got nothing to do with the customer. It is the sharing, revenue sharing between the state government and the central government. So the consumer is only going to see one thing, that is goods and services tax. They are not going to see SGST or CGST. So let's move ahead and see an example. Now we are going to see an example where goods are moving in the state itself, within the state. The goods are moving from one city to say another city. So in this example, you can see the goods are moving from Mumbai to Pune, and the GST rate is, let's assume that it is 16% for the example. So 16% and the sale price is 100 rupees. So 16% on 16% on 100 rupees comes to 16 rupees. Now the state government will take its share and the center government will take its share. Now there is no clarity on how much share the state government will get and the center will get. Now we are assuming they are going to share 50-50% revenue. So in this example, you can see that 8 rupees is going to the state of Maharashtra, as Mumbai is located in Maharashtra, and 8 rupees is going to the center. And the total GST tax was 16 rupees. Now again, the goods are moving from Pune to Nagpur. So again, it's a transaction within the state. Now here we can see how we get credit of input tax against output tax. So here we can see that the sale price is 200 rupees and the GST is 16%. So it comes to 32 rupees. Now again, the state will take its share and the center will take its own share. Now in this we can see in the previous stage we have already paid 8 rupees. We have total we have paid 16 rupees. And here the tax is coming 32 rupees. So we are going to we can set off 16 rupees against 32 rupees. That is the complete 100% input tax available against output tax. So the total tax payable will only be 8 rupees. Now we'll see an example where the goods are moving within the state and then they are moving outside the state. Now in this example, we can again see that the goods are moving from Indore to Bhopal. Both are in Madhya Pradesh state. Now as it is a consumption based tax, the state where it is consumed will get the revenue. Now in this example, first situation, sale price 100, GST, the state takes its share and the center takes its own share. Now from Bhopal, the goods are moving to Lucknow in some other state, that is Uttar Pradesh. So as I said, when there is a transaction between two states, there will be IGST, Integrated Goods and Services Tax. So Integrated Goods and Service Tax is nothing but sum of SGST and CGST. So here we can see that IGST is 16% and the sale prices, so the tax payable comes to 32 rupees, and in the GST we get credit again, so we can set off the credit here. So you can see that the tax payable is only 16 rupees and we are getting 100% credit for input tax paid against output tax. And here you can see initially the transaction was in a particular state, but later on the goods have moved to some other state. So as it is a destination or consumption based tax, the IGST that has gone to the center, and at the initial stage the GST has gone to the Madhya Pradesh. So now the GST, the revenue that Madhya Pradesh state has got, it will be transferred to center, and then the center will share the revenue with the state where the goods were consumed. Now we'll see another example wherein the goods are moving from one state to another, and then in that state again the goods are moving from one city to another city. Now here you can see that the goods are moving from Delhi to Jaipur. Jaipur is located in Rajasthan. So this is an interstate transaction. So we will apply IGST. So the sale price is 100 rupees, IGST is 16, the SAT directly goes to the center as it is consumed in Rajasthan and not Delhi. So Delhi will not get any revenue. Now, in Jaipur, the goods are moving from Jaipur to Jodhpur. Now here, this is a within state transaction. Now here you can see that SGST and CGST will apply because this is a transaction within the state. So SGST goes to Rajasthan state because it is consumed in Rajasthan, and CGST goes to center. But in this, you can see Rajasthan government has given a set off here. But the Rajasthan government has not received any revenue against it. The revenue has gone to the center. Now the center will transfer the revenue to the Rajasthan state. So again, in this example, you can see it is a destination based tax where the revenue directly goes to the state where the goods are consumed. So I can summarize that the GST is a long-term strategy. Nothing is going to happen overnight because there are a lot of challenges to implement GST. So I think it will take another 5 to 6 years to see the effect of GST, and I'm 100% sure after some time it will change India's economy. Thank you so much for listening to the GST session.